Silver and gold are not just moving today. They're announcing themselves. And if you've been watching this space for any amount of time, you can feel it. Something bigger is shifting underneath the price action, underneath the headlines, underneath the so-called experts who keep telling you this rally is tired. Because here's what we're dealing with right now. In the same 24 hours, we've got fresh signals out of Japan, fresh signals out of China, a shockwave out of Hong Kong, and an operational warning from one of the largest bullion businesses on the planet. When you stack those stories side by side, they don't read like random news. They read like a pattern. In this video, I'm breaking down what that pattern is, what it means for silver and gold going forward, why people are still late to this move, and what to watch next so you're not reacting after the fact. We're going to talk prices, but more importantly, we're going to talk about why the prices are acting the way they are. The first clue is showing up where most people are not even looking. Today, silver and gold are giving us a message that's easy to miss if you only glance at a chart. When the market is calm, prices can drift for weeks. But when the market is stressed, the little details start screaming. One of those details is the relationship between the spot price and the futures price. When the immediate price, the right now price, starts acting stronger than the forward price, it's not just a technical curiosity. It's a market telling you this is wanted now. And in metals, wanted now is not a small sentence. You'll hear people toss around terms like contango and backwardation. But the reason traders pay attention is simple. It's a window into urgency. It's a signal about whether the market is comfortable about supply and delivery or whether it's getting nervous. And that matters because silver is not a market where you can snap your fingers and create extra supply. Silver is the kind of market where you can pretend there's plenty until you're forced to deliver. Moments like this tend to show up before bigger moves, not after them. They're the warning lights. And while that's happening, the second clue is even louder. The East is pricing metal differently than the West. For a long time, the world pretended that the official price was the paper quote. But the physical market doesn't care about what a spreadsheet says. The physical market cares about what you can actually get, how fast you can get it, and what you have to pay to remove it from the system. When you see a persistent premium in major physical hubs, that is not trivia. That is price discovery shifting. It's the market saying, we're not negotiating with the paper story anymore. And that's why China matters. Not because it makes for a catchy headline, but because it represents scale. Scale of buyers, scale of manufacturing, scale of industrial demand, and scale of capital that can move when policy shifts. The West has been trained to believe the precious metals market is a niche. But the minute industrial demand, household demand, and institutional demand move together, it stops being niche. It becomes infrastructure. While people argue about whether silver is overbought, the more important question is, what if silver wasn't overbought at all? What if silver was simply underpriced for years and now it's being forced to catch up? That would explain why each sell-off doesn't behave like a collapse. It behaves like a reset, like the market is trying to throw weak hands overboard while the underlying pressure keeps building. This is exactly where mainstream narratives start getting weird. When prices rise, you see the same routine. First, they ignore it. Then they ridicule it. Then they explain why it's temporary. Then, right when it becomes obvious, they suddenly discover reasons to be afraid. They'll tell you the rally is over, the top is in, the smart money is exiting. And then quietly, the real metal keeps getting tighter. Let me show you the two biggest forces pushing this forward. The day-to-day headlines matter, but the macro environment is the engine. The first macro force is geopolitical fragmentation. Trade is no longer just trade, it's leverage. Currency is no longer just currency, it's a weapon. Supply chains are no longer just supply chains, they're security. In that kind of world, trust becomes the rarest commodity. And when trust becomes rare, anything that doesn't depend on trust starts to look valuable. That's why gold has historically been the asset that survives regimes. And that's why silver, when it's tight, can move like a wildfire. Because silver is both money and material. It's a strategic metal hiding inside a precious label. The second macro force is financial stress, specifically bond stress. When bond yields rise sharply, it's not always good news. Often it's the market demanding a higher return because it's getting uncomfortable. And when bond prices fall, somebody is selling. Not because they feel calm, but because they want out or need liquidity, or are being forced to adjust risk. When you see bond volatility rising while metals are rising, that's not random. That's the menu shrinking. For years, people had an easy playbook. Stocks went up, bonds protected, cash was safe. That playbook made people lazy. It made them believe there would always be a bid under everything. But when stocks wobble, and bonds wobble, and currencies wobble, suddenly the old playbook doesn't work. And when the old playbook doesn't work, people start searching for a new one. That search is happening right now. Let's talk about Japan, because Japan is a case study in what happens when a country lives on low rates for so long that the whole system becomes addicted. Japan's bond market has been a global anchor for decades. People used it for carry trades as a funding source. People treated it like a stable machine. But stability is not the same as strength. Sometimes stability is just delay. When yields begin rising meaningfully, it changes the math. It changes the risk. It changes how capital flows. And if the carry trade unwinds, it doesn't unwind politely. It unwinds like a crowded exit. And here's the key. When large pools of capital are forced to reassess bond risk, they don't just switch from one bond to another. They begin asking, what do I own that is not someone else's promise? Gold is not a promise. Silver is not a promise. They're not perfect, but they don't require a central bank to behave. So Japan is not just a Japan story. It's a mirror for what happens when the bond world has to relearn fear. While that's happening, we have another layer. Stock market weakness showing up at the same time metals remain strong. This is important because in many past moments, metals would move with the broader market during risk-off selling. People would sell everything for cash. But when metals can hold up while equities sag, it suggests something else. Rotation. It suggests money is not just panicking, it's choosing. That choice becomes more powerful when the list of safe places gets shorter. Real estate has its own cycles and risks. Crypto is volatile. Stocks can be overvalued. Bonds can be unstable. Cash can be diluted. So what does the crowd do when the options look ugly? They look for the corner of the room they've ignored for years. And that corner is metals. This is where the law of small numbers becomes your friend. If the allocation to metals is tiny, then even a small shift in allocation can create a large price impact. You don't need everyone to buy silver. You don't need a majority. You need a minority that's large enough to overwhelm a market that is already tight. Let's bring in the institutional angle because this is the story that can change things faster than most people expect. In the world of wealthy portfolios and family offices, metals allocations are often surprisingly small. And when an outlier shows up, it's worth paying attention. Not because wealthy people are always right, but because they have access to information and advisors and risk frameworks the average person never sees. When one of them shifts aggressively, it can signal what's happening behind closed doors. So when you hear about a billionaire in Hong Kong putting a meaningful chunk of personal wealth into gold, that should not be dismissed as a vanity move. That's a worldview. That kind of allocation says, I don't like the future path of paper. And it gets even more interesting when you compare that to how little most big pools of money have in metals. If the average is low, then the gap between low and normal is huge, and the gap between normal and defensive is even bigger. The real question isn't, is gold too high? The real question is, how under-allocated is the world? Because when under-allocation meets fear, it becomes urgency. And urgency meets a tight market, and tight markets don't negotiate. Let's jump back to Hong Kong, because Hong Kong is where you can sometimes see human price discovery before the rest of the world admits it's happening. You can analyze charts all day, but nothing beats watching people line up for metal. When people line up, it means the story has moved from theory to behavior. When a dealer in a major hub sells out rapidly, that doesn't mean the world is ending tomorrow, but it does mean something is changing in the psychology of buyers. It means more people are deciding to hold the asset itself, not the idea of the asset. That distinction matters because in a calm environment, people are happy to hold paper claims. In a stressed environment, they want the thing. Here's where I want to pause and ask you a question because your answer helps shape future videos. Do you think this is mainly an investor story, or do you think this is turning into an industrial shortage story? Drop investor or industrial in the comments. We can't talk about demand without talking about a story that has been quietly escalating. Major bullion businesses feeling strain. When a large dealer changes minimum order requirements or service levels or issues a public note about historical volume, that's not marketing fluff. That's operational stress. It means demand is not just strong. It's strong enough to force decisions they'd rather not make. When the biggest players start signaling strain, it's a reminder that physical markets have limits. Websites can display available until the moment they can't. Supply can look smooth until the moment it doesn't. This is why the paper versus physical conversation keeps coming back, because paper contracts can be created in huge quantity. Physical metal cannot. When physical demand rises, the whole system gets tested. The system can handle a lot, but it can't handle everyone waking up at once. Let me connect these threads. We have price strength. We have signs of urgency. We have East-West premium behavior. We have Japan bond stress. We have equity weakness. We have billionaire allocation signals. We have dealer strain. What does it add up to? A market that is not behaving like a tired top. It's behaving like a transition, like a regime change. Like the moment when the story shifts from only enthusiasts care to more serious money needs exposure. If that's true, then the next question is, what could accelerate it further? The market doesn't need 1,000 reasons. It needs one reason that hits at the wrong time. One catalyst could be policy. Another could be a bond event. Another could be currency volatility. Another could be an industrial supply surprise. Another could simply be momentum pulling in people who have been ignoring it. In the early phase of a major move, people mock it. In the middle phase, they regret not acting sooner. In the late phase, they chase. We're not in the chase phase yet. You can tell because the broader population still treats metals like a niche. But the cracks are showing. Let me go deeper on one thing that gets overlooked. The idea of structural deficit. If the market is consuming more silver than is produced year after year, you can paper over that reality only for so long. Eventually, inventories become the buffer. And when inventories become the buffer starts shrinking. And when the buffer shrinks, the market becomes more sensitive to any demand shock. That's how tight markets work. They don't move smoothly, they move suddenly. When you see these rare signals, spot strength relative to futures, increasing premiums in key regions, record volumes and operational changes, those are often the first hints that the buffer is being stressed. I also want to address a narrative trap that catches people. It goes like this. If the price is higher than last year, it must be too late. That's a psychological trap, not analysis. A price can be higher than last year and still be early in a secular move. Bull markets don't move in a straight line. They move in waves. The waves shake people out. Then the trend continues. The better approach is not to obsess over the last $2 move. The better approach is to watch the drivers and see if they are strengthening or weakening. Right now, the drivers look like they're strengthening. Let's talk about the 2% problem, because it ties everything together and explains the potential scale. If only a small percentage of large portfolios are in metals, then metals are not priced for broad institutional participation. They are priced for a niche. So if that niche becomes mainstream, the pricing has to adjust, and it doesn't adjust slowly if the physical side is already tight. This is why market cap comparisons matter. When you see giant equities sitting near the top of global market value, it's a reminder of how much capital is sitting in confidence-based and policy-sensitive assets. If even a small slice of that capital decides it wants insurance, it doesn't take much to overwhelm a much smaller market. Don't underestimate the power of a small shift. Let me talk about how fast sentiment can flip. For years, silver holders were mocked, dismissed, called conspiracy theorists, called every name under the sun. But what happens when the people who mocked you start wanting the same thing you wanted at the same time? That's when markets become disorderly, because the people who arrive late don't arrive calmly. They arrive emotionally. They arrive after a trigger, and they tend to overreact. And that overreaction is exactly what causes the strongest vertical moves. It's not steady buying, it's urgent buying. Let's be responsible here. I'm not telling you to make reckless decisions. I'm not your advisor. You have to decide what fits your situation. But I do want you to understand the structure of the market you're watching. Silver is not like an infinite digital asset that can be minted in endless supply. Silver supply is constrained. Demand is varied. And inventories matter. What happens if demand grows while supply can't keep up? It doesn't mean everything explodes tomorrow, but it does mean the market's balance has to be reestablished somehow. And usually the mechanism is price. Price is how markets ration scarcity. That's not drama. That's economics. There's another piece to this puzzle. The idea that new investment channels can open the floodgates. Whenever there's discussion about retirement accounts, large pools of managed capital, and expanding access to certain asset classes, it's not just a policy debate, it's a demand potential debate. If more people can allocate into metals-related exposure, that's additional demand. And even if those allocations start small, they matter when the market is tight. And there's an even more disruptive concept on the horizon: tokenization backed by real metal. If a system emerges that lets people hold metal-backed units in a frictionless way, it could pull in people who otherwise never would have bought coins or bars. That's not guaranteed, but it's a serious possibility. And when markets are tight, possibilities matter. Let me bring it back to the present and the why now feeling. Why does it feel like things are accelerating? Because we're seeing multiple confirmations at once. Confirmation from the price action. Confirmation from physical behavior. Confirmation from macro stress. Confirmation from institutional signals. When confirmations stack, confidence rises. I want to address something that always comes up: the temptation to focus only on silver and ignore gold, or focus only on gold and ignore silver. I see them as related but different. Gold is the monetary anchor. Silver is the hybrid. Gold moves like money. Silver moves like money and like a strategic commodity. That's why silver can be more volatile. It can lag then sprint. When you see gold making new highs, don't underestimate what that can signal for silver. Gold often leads. Silver often follows with more intensity. That's why people are watching the ratio. Not because the ratio is magic, but because it tells you relative value dynamics. If the ratio is stretched, it can mean silver is cheap relative to gold. And when silver is cheap relative to gold, it can create conditions for explosive catch-up moves. Let's talk about the perfect storm idea without turning it into hype. A perfect storm doesn't mean guaranteed outcomes. It means the environment is stacked in a way that favors a certain direction. Right now, the environment is stacked in a way that favors metal strength. Geopolitical uncertainty, bond stress, currency anxiety, industrial demand, potential policy shifts, physical tightness, institutional under-allocation. That's the storm. The reason I'm emphasizing this is because it explains why the rally can extend even when people feel like it already ran. When the storm is structural, it doesn't end because a chart looks overbought for a week. It ends when the drivers reverse or the system finds a new equilibrium. And I don't see those drivers reversing cleanly right now. Let me talk about what you should watch next, because this is where people either stay ahead or fall behind. First, watch the bond market, not the headlines, the behavior. Watch yields. Watch volatility. Watch auctions. Watch confidence. When the bond market is calm, it's like a quiet engine room. When it gets noisy, it affects everything. Second, watch physical premiums in major regions. If premiums stay elevated or widen, it suggests physical demand is not just a flash. Third, watch reports of dealer supply strain. When big dealers keep up easily, it suggests supply is flowing. When they start changing terms, it's a sign the flow is tightening. Fourth, watch how metals behave on equity down days. If gold and silver keep holding up while stocks weaken, it suggests rotation is still active. Fifth, watch institutional language. Pay attention to what large investors, large banks, and large family offices are saying about insurance, diversifiers, and real assets. The words change before the allocations do. I want to ask you one more question because your perspective matters. Which story do you think ends up being the biggest driver this year? Japan's bond situation, China's physical pricing, or the under-allocation problem in the West? Drop Japan, China, or allocation in the comments. Let's address something both exciting and dangerous: the possibility of a squeeze narrative. People love the word squeeze because it implies a quick payday. But real market dislocations don't always play out in a clean Hollywood way. They can be messy. They can take time. They can involve volatility that shakes out even strong hands. The smart approach is to treat the market with respect. Understand that volatility is part of the journey. Don't let hype replace risk management. That said, a tight market with rising demand can create conditions where price moves are sharper than people expect. Not because of conspiracy, but because of mechanics. If a major dealer is dealing with record order counts and silver demand is rising faster than gold demand, that tells you something about the public's preference. It suggests silver is not just a collector play. It's being treated as the more accessible alternative, the way people can participate without needing the larger capital outlay. When gold prices are high, silver becomes the entry point for more people. That can increase volume massively. And higher volume doesn't just stress dealers. It stresses mints, logistics, and production capacity. Those are real-world constraints. When demand surges, it can create bottlenecks. Bottlenecks create delays. Delays create more urgency, and urgency feeds demand. That's how feedback loops form. I want to zoom in on one subtle psychological factor that can change the whole game: trust in narratives. When the mainstream narrative says everything is fine while people feel stress in their lives, higher costs, unstable policy, uncertain jobs, the narrative loses power. People start searching for alternatives. Gold and silver are not just assets, they're symbols. They represent opting out of the narrative. They represent choosing something that doesn't need permission. That symbolic power matters more in unstable times. And it's why when fear rises, metals often become more attractive, even if they are not productive assets like businesses. People don't buy them for yield. They buy them for certainty. A quick word on miners because people ask about leverage. Miners can outperform, but they carry operational and political risk, and their costs can jump when energy moves. Think of physical metal as the foundation, and miners as optional exposure that needs stricter risk control. We also have to talk about the idea that this rally might still be early. People hate that idea because they want certainty, but the evidence points in that direction. Why? Because broad allocations are still small. Because mainstream coverage still treats metals as fringe. Because the public still hasn't flooded in. Because the bond market stress is not resolved. because geopolitical fragmentation is not resolved. Because physical demand signals are real. That's not proof of a straight lineup, but it is evidence that the story is not finished. Let me make a practical point that often gets ignored. Timing versus positioning. Most people try to time. They want the perfect entry, the perfect top, the perfect dip, and in doing that, they often miss the move entirely. Positioning is different. Positioning means you accept you can't nail every wiggle, but you want exposure to the long-term drivers, and you adjust responsibly. That mindset tends to survive volatility better than the perfect timing mindset. Let's not ignore the elephant in the room, the future path of currencies. When governments run deficits, when debt grows, when central banks manage crisis, the currency becomes the release valve. Sometimes slowly, sometimes suddenly. You don't have to be dramatic to see that currencies are under pressure globally. And when currencies are under pressure, hard assets tend to reprice. That repricing can feel mysterious to people who only view markets through a stock chart lens. But it's not mysterious. It's math. It's psychology. It's trust. There's one more angle I want to highlight. What happens if the West is forced to acknowledge that the East is setting the real physical price? Because if the East consistently pays higher for physical and continues pulling supply, the West's paper pricing becomes less relevant. When paper pricing becomes less relevant, the entire system's credibility gets questioned. And when credibility gets questioned, you don't need a collapse. You need a shift. A shift where physical availability matters more than paper quotes. If that shift accelerates, it would change how people think about silver and gold permanently. I'm not saying that's guaranteed, but the pieces are on the table. Here's a simple map of what could happen next, and I want your take. 1. Metals consolidate while premiums stay firm, then the next leg higher follows a bond or policy catalyst. 2. Metals pull back, panic shakes out weak hands, and the reset sets up the next run. Which one do you think is more likely? Drop 1 or 2 in the comments and tell me why. Let me wrap this in a way that keeps you ready, not reactive. If you're watching the bond market, watching physical premiums, watching dealer strain, and watching institutional language, you are already ahead of most people. Most people only wake up after the move, after the headlines, after the mainstream permission slip. But by the time permission arrives, the price has already adjusted. The whole point of following these signals is to understand the environment before the crowd does. And remember, none of this is about fear. It's about awareness. It's about choosing to understand what the system is doing and what the market is whispering before it starts shouting. If you got value from this breakdown, do one thing for me. Subscribe. Subscribe so you don't miss the next update, because the next few weeks could get volatile fast. Hit like if you want more frequent gold and silver updates. And tell me in the comments whether you want more coverage of the macro side, the physical side, or both. Keep your eyes open, keep your mind calm, and keep your strategy honest. We're living through a period that people will talk about later like it was obvious. But right now, while it's happening, it's never obvious. Take care of yourselves. Take care of each other. I'll see you in the next one.